Welcome to our second quarter 2024 fund overview for the Matco Global Equity Fund. In the second quarter, world markets began with a mild drawdown in April of about 5%, finishing the quarter up about 3.6%. Economic data through the second quarter was a bit mixed. Global inflation continued to decline on a year-over-year basis as personal spending slowed. However, at a business activity level, the U.S. S&P Global Composite PMI continued its upward trend from the lows in April. Global valuations continued to expand in the second quarter as investors anticipate earnings growth through the second half of 2024. Chinese property markets continued to be depressed, but Chinese equity markets participated in a fairly strong up move in the quarter. While in Europe, the snap elections in the UK and France dampened markets. Finally, in Japan, the market continued to march higher despite a rise in inflation. In terms of activity within our fund, the rather large increase in US equity valuations and cooling jobs market, we chose to trim some exposure in consumer cyclicals and add to healthcare and consumer staples. In the quarter, our top contributor to performance was Applied Materials, Colgate-Palmolive, and Microsoft, while the top detractors were Fastenal Company, Lowe's, and Starbucks. The fund's valuation currently sits at 19 times versus the benchmark at 21 times on a trailing 12-month price-to-earnings basis, which provides some downside protection. Our return on invested capital ratio for the portfolio is 19%, while the benchmark sits at about 15%. And we use this as a way to demonstrate the quality businesses which we choose to invest in. For fund performance, Series F net of fees has returned negative 1.1% in the quarter, 9.5% year to date, 15.9% in the last year, 6.5% per year for the last 3 years, and 10% per year for the last 5 years. For long-term investors, properly allocating to global markets with a keen eye on investing in quality businesses at reasonable prices has delivered both compelling absolute performance and risk management in times of volatility. For more information, please visit our website.